But my forecast for gold this year is a high of about 2,500. Silver, I'm looking for maybe a possible touch to 30 or near there. But I think 30, and this is more of a guesstimate than a knowledge-based statement. And all these things are favorable to gold. And gold is actually a mainstream investment, even though no one will admit it, because they want to keep it quiet. They don't want the public involved. They certainly don't want gold to go rogue. They want to keep it under management. None of that applies to silver. But if silver were acted or was treated as if it was a monetary metal, and they had to keep a certain ratio of silver to gold, then of course there'd be a lot of buying pressure in silver by the banking system. Again, there isn't.
According to silver expert David Morgan in his recent interview with Liberty and Finance, throughout history, a strategic move for investors in precious metals has been to exchange gold for silver when the ratio between the two metals exceeds 80 or 85. This ratio is currently at such a level, indicating that it may be wiser for those entering the market to opt for silver over gold, provided they possess the necessary patience. Silver rebounds as the gold-silver ratio pulls back towards the 89 level, with the US dollar's pullback providing additional support to silver markets. Moving above the $22.50 level will push silver toward the recent highs near the $23 level. Gold is currently trading near its peak value, primarily due to robust demand, particularly from central banks. Central banks now hold an estimated 36,700 tons of gold as the global scramble for Federal Reserve note alternatives continues. This heightened demand is largely attributable to gold's status as a prized asset, especially among central banks, who regard it as a secure store of value, particularly since Basel III regulations classify it as a Tier 1 asset. While gold enjoys substantial institutional favor, silver lacks similar recognition from central banks. Nonetheless, David speculates on the potential ramifications if silver is treated as a monetary metal with a mandated ratio relative to gold. In such a scenario, the resultant increase in demand could exert significant upward pressure on silver prices, but right now, we can see that silver faces a potential deficit due to increasing industrial demand and a shortage of mineable silver. Low prices make primary silver mining uneconomic. Despite this, David notes silver's popularity among the public and industries, suggesting that a surge in buyers could significantly boost its value due to its scarcity compared to historical levels. We will present clips from David Morgan's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Been advantageous for precious metals investors to swap gold into silver above 80, 85. Historically, we're there now. If you're going to enter the market, you're much better if you have patience to buy silver rather than gold at this point. One thing I want to point out that, I lectured on several years ago, and was what if silver were treated like gold? And the basis is, where is gold? And gold's, pretty much near an all-time high. And why is that? Well, demand. And, we just went through the demand thing, which doesn't make sense with silver. With gold, it sort of does, because gold has been coveted by the central banks in 2022, buying at a 40 or 50-year record. 2023 looks like it's on track to be similar. So far, 2024, we don't have enough data. But central banks have been buying gold. It's money of last resort. They put it on their balance sheet. It's a Tier 1 asset since Basel III. And all these things are favorable to gold. And gold is actually a mainstream investment, even though no one will admit it, because they want to keep it quiet. They don't want the public involved. They certainly don't want gold to go rogue. They want to keep it under, their management. However, none of that applies to silver. But if silver were acted or was treated as if it was a monetary metal, and they had to keep a certain ratio of silver to gold, then of course there'd be a lot of buying pressure in silver by the banking system. Again, there isn't. There's really no central bank that has any substantive silver to my knowledge. India used to. None of it was LBMA grade. It was 90%-ish. It wasn't very much. But yet, as a monetary asset, not in the banking system, but held by the public and needed by industry to the level that it's needed now, there's still a great deal of demand. And if any pseudo institutions or large money, we could say, pension funds, even a bank. I mean, there's nothing to say that the Bank of India wouldn't say, we want silver. We're going to use it as a monetary asset or whatever. It's such a precious commodity, and it's in such short supply relative to historical standards, where any significant buying will definitely force the price higher at some point. And I say that at some point is this year. But remember, I used the word significant. If you're able to, through the psychological operations on the monetary system at large, convince people that you need to have a piece of plastic or something on your phone and that digits are the only thing that matters, then perhaps my life's work is going to go out the window. I'm saying that tongue in cheek somewhat. But nonetheless, money is either substance or it's not. Anytime it's been just a legal construct, there's been problems. Whenever it's been specie, there hasn't been nearly as many problems. So coming back to basics is an economics lesson I think is still in our near future.
Silver faces a significant disconnect. While physical demand strengthens considerably, prices lag. Analysts at metals focus project Global Silver demand for calendar year 2024 to reach 1.2 billion ounces, marking the second highest level recorded for the precious metal. This insight comes from a report prepared for the Silver Institute, a prominent silver industry public relations and market reporting association. David emphasizes the significant role played by paper markets in the silver trade, expressing concern over their challenges in efficiently managing the fluctuations in market demand. He draws attention to the remarkable increase in retail demand for silver witnessed in recent years, underscoring how this surge starkly contrasts the comparatively muted interest shown by institutional investors in the precious metal. However, David observes a discrepancy between market behavior and institutional actions. Despite observable rallies and opportunities for algorithmic trading, institutions have not capitalized on the silver market as expected. ETF holdings have not seen significant additions similar to those witnessed in 2020. This puzzling trend raises questions about institutional behavior and reluctance to engage with silver assets. Let's get back to the interview.
So now we come to your question, or the people's question, and that is, where's the inventory coming from? Well, first of all, the deficit that the Silver Institute refers to is valid. There's been more offtake in either investment or industry than there's been mining, supply, and recycling. So that number is valid. And what we have to do is look at the obvious, which I'm pretty sure you implied. And that is, wait a minute, the LBMA inventory is down. The COMEX inventory is down. And what's really not talked about enough, in my view, is that the ETF inventories are down. So the supply has to come from somewhere, and I would suggest it's coming from the LBMA, the COMEX, and the ETFs. The problem is, how do you keep it this low in price and meet that demand, which has always been the really big question you can think about. Because even though the paper markets rule the silver market more than any other futures market, the paper market still, or maybe oil's more manipulated than silver, believe it or not. Regardless, that's an academic question. But back on track, the futures market runs all the commodities. So the big question is, what is the key? And the key is that the demand on the investment side the last couple of years has been retail. If you go back to 2020, the demand for silver on the institutional side was 320 million ounces. And if we go back in time and look at the Davos, now better known as World Economic Forum, and Bloomberg's finance guys were there interviewing different people. And they interviewed a gentleman named Scott Meanert, who was the chief investment officer for Guggenheim. And they asked him, what's his go-to investment in 2020? And his answer was silver. They just about fell off their chairs. And 320 million ounces was bought in the ETFs that year. Scott Meanert is no longer with us. I'm not saying that Guggenheim bought all of that, but what I am suggesting is it's very unusual to have the rallies that we've had from 2020 till now. And yes, it's gone up and down, but there's been substantive rallies that any algorithm would pick up on. And yet the institutions that run those algorithms don't seem to be playing the game. Because if they were playing the game, the ETFs would be added to like they were in 2020, and they are not. They are draining out. So it doesn't make any sense as far as what the institutions are doing. So I could suggest for your consideration asking yourself, why are they giving up silver out of those locations? And you can answer your own questions. Is that the last resort? You can't get it from anywhere but an ETF, the LBMA or COMEX. Certainly most retail and institutional, I mean, there's big family offices and some sovereign wealth funds and some pension funds that own silver. And usually these are very tightly held. And they're not willing to depart with silver at $23 an ounce when the average price for a primary silver producer is about the same. I mean, that's a break even. You don't invest to break even. You invest, especially in silver.
Gold and silver are anticipated to continue their ascent in 2024, driven by expectations of interest rate cuts by the U.S. Federal Reserve. Silver is poised to perform exceptionally well in a scenario where the Fed implements easing measures, historically outpacing gold during such periods. Given silver's recent underperformance relative to gold, there is substantial potential for it to make significant gains. Many analysts believe that the resulting move could be pretty dramatic. What are your thoughts on future price movements of gold and silver? Share your thoughts in the comment section below. If you find this video informative, remember to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.